Yeah, thank you very much. And well, I set myself the goal to give a kind of post-Keynesian perspective on this growth regime, growth model debate. In the course of doing so, I noticed that this might be a bit ambitious to cover everything, so I've slightly changed the title, so it's just a review of some post-Keynesian approaches, not claiming that I'm dealing with everything. Now, the starting point is similar than the one by Bruno. So it's the Baccaro-Ponteson paper and the debate which it has triggered, and also some post-Keynesian responses towards this by different authors. You can see them here. Some of them taking this growth model perspective as a step forward, at least opening a window for getting post-Keynesian macroeconomics into comparative and international political economy, while others have rather stuck or kept with or have kept this more Hall-Soskich variety of capitalism distinction. What is missing so far, and that's the purpose of what I'm doing here, is to provide an overview, a systematic overview of the post-Keynesian contributions to this debate, which goes back, or to this area of research, which goes back much further than just the recent responses or picking up the Baccaro-Ponteson results. Goes back much further. It is, so to speak, part or an integral part of post-Keynesian macroeconomics, as I will explain. The purpose is, first of all, to clarify the different uses of demand and growth regimes in post-Keynesian economics research, because I think this clarification is required in particular for those coming from comparative political economy, because I see that there sometimes are some misunderstandings. So in order just to facilitate the communication with CPE and IPE, I would like to clarify these issues. And I see basically three different types of uses of demand and growth regimes, which I prefer over growth models. And in the course of the presentation, it might become clear why. So the first use is that we are using it in terms of identifying the main growth determinant in a demand-led economy. So this may then be investment-led growth, distribution-led growth, or autonomous demand-led growth. The second use is that we're using it as a response towards the equilibrium solution of the model, towards some of the model parameters. So then there comes in wage or profit-led growth, or effects of the interest rate on the equilibrium, which may give rise to different regimes, or of the debt ratio, or of shareholder power. And the third use is that we're using that in order to describe empirical historical episodes in the development of capitalism, sometimes also the coexistence of different regimes in the same episode. And as you will see, these are different types of making use of this demand and growth regime terminology or concept. The second purpose of the paper is also to show that in post-Keynesian economics, there is already a bit of political economy in there, a bit of political economy research, and we should be aware of that. And even post-Keynesian should probably highlight this a bit more. So the paper is structured. So first we have the theoretical part, so distinguishing demand-led growth regimes in post-Keynesian distribution and growth models. Then I have a brief overview of the use of demand and growth regimes over time, so describing in particular or analyzing the change from the golden age towards neoliberalism and finance-dominant capitalism. And in the fourth part, I then review the recent debate on the macroeconomics of finance-dominated capitalism and the coexistence of different demand and growth regimes. Let me just give you an overview of what is in that paper. So I start with a broad tent approach on post-Keynesian economics, which can be distinguished from orthodox economics together with other heterodox economics according to these 5 propositions, which you see here on the left side. So realism, the use of environmental consistent rationality and satisfying agents, holism and organicism, focus on production and growth, and in the political sphere, the focus on regulated markets. And then we have 5 core claims which distinguishes post-Keynesian economics from other heterodox schools of thought, and that's in particular the non-neutrality of money in the short and in the long run, the use of the principle or the relevance of the principle of effective demand in the short and the long run, the notion of fundamental uncertainty, the view that economic processes and therefore also our modeling of economic processes should be aware that these processes take place in historical and irreversible time and are therefore largely past dependent. And finally, the importance of distribution and distribution conflict, and I will focus in particular on that in what follows. If we look at Robinson, one of the founding mothers, or the founding mother of post-Keynesian growth theory, distribution and growth theory, then her main claims have been that, that post-Keynesian growth theory first means that investment determines saving also in the long run when it comes to accumulation and growth, and that second, there is no equilibrium growth path out there towards which the economy will converge, but the disequilibrium process has a feedback effect on the long run equilibrium or the state of rest to which the economy would converge. So in other words, growth is path dependent. In post-Keynesian economics, we basically have 3 strands of growth theory. We have the Caldo-Pasinetti-Robinson strand, in which distribution is somewhat downgraded because the adjustment of saving to investment in the long run takes place via changes in distribution. They have some exceptional cases like the inflation barrier when this doesn't take place or this is prohibited, but generally distribution is the adjusting variable. Whereas in the 2 other strands, the Kalecki-Steinle strand and the Saffian supermultiplier strand, distribution is the exogenous variable, which is then open to political economy explanations, and the adjustment of saving to investment in the long run takes place through other channels, through capacity utilization in the Kalecki-Steinle tradition and through the ratio of autonomous expenditure to the capital stock in the Saffian supermultiplier tradition. That's the reason why in the theoretical part I focus on these 2 traditions. And first I want to briefly say a few words on the Kalecki tradition, Kalecki-Steinle tradition, because that's the tradition which has figured prominently in the work of Baccaro-Pontus and others who are relying on that. The Kalecki-Steinle tradition holds that growth is driven by firms' investment and capital accumulation, and investment itself is determined by sales or growth expectations and by capacity utilization, and in some models also by profitability. As I said, capacity utilization is endogenous. Wage profit shares are determined by markup pricing, by class conflict, if you like, also in the labor market. We have a paradox of saving, and usually the growth path we observe is well below full employment and full utilization. Based on that, we then have several distinctions of distribution-led growth. We have the distinction between wage and profit-led growth determined by the capital-labor conflict. Here in the neo-Kaleckian model, we only had wage-led growth, but then if for the closed economy, but if we then add exports or net exports, we may even have a profit-led growth, so as a second variant. This second variant is also important in the Baduri-Margolin model, which is frequently cited and quoted, where profit-led growth can come in directly through the introduction of the profit share into the investment function, even for a closed economy. And in recent work, this might get modified if we introduce inequality in the distribution of profits or in the distribution of wages. Tom Pally has an interesting paper where he allows for that. Here we may then have profit-led growth through the channel in which means that workers get a higher share relative to managers in the wages, or workers have a higher share relative to capitalists in the ownership of the capital stock, which then may also lead to profit-led growth. The opposite of that is that higher inequality of wages, so more wages or salaries going to the managers, lower wages are going to the workers, may also lead to seemingly profit-led growth if workers have access to credit and can compensate the loss in income through higher credit and thus maintain or even raise their consumption. That is the debate, which includes relative income effects, and they may also generate profit-led growth. So that's one area. We have extended this towards productivity in several papers. You can see the references there. Introducing the effect of demand on productivity growth, but also income distribution on productivity growth. And this may then lead to wage or profit-led overall or potential growth, combining the effect of demand with the effect on productivity. This is, I think, similar to what Bruno has shown with respect to Boyer, linking up a productivity regime with a demand regime. We have also papers which then examine the effect on employment, and they talk about employment, profit or wage-led employment regime. So that's one area of distribution conflict which has been introduced. Another area of distribution conflict is the conflict between between creditors and debtors, or between rentiers and the firm sector. And the business sector. Here we have the distinction between different cases, because in this conflict, post-Keynesians are treating the rate of interest as a distribution parameter, and changes in the rate of interest are treated as cost for firms, but revenues, or cause a change in revenues for the rentiers. And this may then lead to different regimes depending on the relative responses. So if there is a strong response of the rentiers consuming more when interest revenues are rising, we may then get what Lavoie used to call the puzzling case, whereas in the opposite, we may have the normal case. So here we have, again, different distinction with regard to changes in the interest rate. This can be taken one step further, introducing similar channels, but on top of that, introducing shareholder power. So that's the way we have initially approached the increasing shareholder power related to financialization and finance-dominated capitalism. And here also we can then distinguish different regimes, a finance-led demand and growth regime in which, first of all, we have this puzzling case with regard to income distribution and the effects on consumption and investment. And we have a weak effect of shareholder power on firms' animal spirits. We may have a finance-burdened regime in which we have the opposite, and we may have in between a profits without investment regime, which is quite important when it comes to our analysis of finance-dominated capitalism. Profits without investment regimes, one of the features as we see it of finance-dominated capitalism, can, if we start from Kalecki's profit equation, be generated by either, so that's the equation 2, which you see here, either higher consumption out of rentiers' income, by higher government expenditure, higher government deficit expenditure, or by higher net exports, or by lower saving out of wages, out of workers' income, which might also mean workers go into deficit. The alternative approach, the Sraffian supermultiplier approach, is an approach in which growth is driven by autonomous non-capacity creating demand, which is either autonomous consumption, residential investment, exports, or government expenditures. Because here the assumption is that in the long run equilibrium, the rate of capacity utilization is at some normal or target rate of the firm sector. And as I said, distribution is given by conflict, relative powers of capitalists and workers, and saving adjust to investment via the relation of autonomous demand to the capital stock. What we would see here is below full employment, but normal capital stock utilization growth path, which are driven by autonomous demand. These are the technicalities. I will not go into that for the sake of time. What is important here is that if we are in a long-run equilibrium, then the induced components of demand, so induced consumption, investment, and imports, generate a multiplier effect. And in the long-run equilibrium, this multiplier should be constant. And this means that changes in distribution or changes in behavioral coefficients related to this multiplier only have short or medium run level effects on the growth path, but not on the growth rate, which in the long run should be given by the growth rate of autonomous expenditures. Now, what does that mean for a growth regime analysis? So from the Kalecki-Standel approach, we have growth regime analysis in which growth is driven by investment, and we would have to analyze the determinants of investment as well as the determinants of saving or consumption. So which I mentioned for the models. We would also have to look at the external sources of demand, which have been highlighted by Kalecki. From this, we may get distribution-led growth regimes at the different levels. From the Sraffian supermultiplier models, we would get that if we are really in a long-run equilibrium, growth would be driven by the autonomous components of demand, and we would have to look at the determinants of these components. However, this is a long-run equilibrium, and we cannot be sure that the data we observe always reflect these long-run equilibria. And as I've tried to highlight, in the traverse, the convergence towards this long-run equilibrium, also behavioral coefficients and income distribution may have a role to play. In this sense, I would argue, and that's one of the main conclusions of this theoretical part, for growth regime analysis, these two approaches, although different with respect to the determination of long-run growth regimes in theory, or growth equilibria in theory, for growth regime analysis, the implications are not so different. Now, let me briefly more or less skip that. I just want to highlight the authors. If you go back a bit in the history of post-Keynesian contributions, you find several contributions which have analyzed the different stages of capitalism from the golden age towards neoliberalism and finance-dominated capitalism, and which have included the conflict over income distribution and the institutions which have temporarily moderated this conflict and have established a kind of social consensus. Cornwall, for instance, in their work called this a social bargain, which has dominated the golden age period, the social bargain between workers, capital, and the state, together with US international hegemony, has created golden age conditions, and this has then been undermined. This has eroded endogenously in this process, and then has given rise to neoliberalism. So we have class conflict and institutions in there. The same is true for Joseph Steindl and his work in the 1970s, where he also has an analysis of conflict institutions which have generated the golden age period and which were then undermined in the 1970s. And in particular, in his very late work, he relates this to the changes also in power relationships within the capitalist class, the change towards the dominance of finance, which has then contributed to what he calls a stagnation as a policy. And he relates that to Kalecki's 1943 paper, which Bruno has also mentioned. So it's in there. Lastly, John Smith has an interesting approach where he also relates the erosion of the Golden Age period to the conflict between capital, labor, and the rentiers. And for him, the important feature of the erosion is that real interest rates, which were positive, low but positive in the pre-1970s period, became negative in the 1970 period, which then changed the attitude of the rentiers. He calls this the revenge of the rentiers, and which then led to a change in policy similar to what we have seen in Steinway. So it's in some of the post-Keynesian work we would have to make to rediscover this work and reap the insights from this work. Let me finally come to the current debate or the current contributions of post-Keynesians to the analysis of growth regimes, demand and growth regimes in finance-dominated capitalism. Again, I think won't go into that. Basically, we have three levels of analysis which we can contribute to the debate, and I would rather see them as complementary and not as contradictory or mutually exclusive. The first level of analysis is the one which I have used with different co-authors for more than 10 years. And that is what I now call the national income and financial accounting decomposition approach. We haven't called it this way in our previous papers, and that may have caused some misunderstandings. The basic idea here is to look at national income accounting and financial accounting. So looking at financial balances and looking at growth contributions. And based on that, just cluster different regimes. We have these four regimes, which you see here. I don't want to read the criteria for each of them. And this then allows us to analyze countries, and we have done a lot of multi-country studies on this, and we have found these four types of regimes for the pre-crisis period, and we have analyzed that in the period after the 2007-09 crisis. We have this shift of regimes to the northeast, which you see here, towards export-led mercantilism. We don't find that in a paper with Ümit Akçay and Benjamin Jungmann for emerging economies, where the countries remain along the diagonal, so no systematic shift of regime patterns. Now, what is the insight from this approach? The insight is that we find we examine the structure of demand dynamics, and this reveals some related imbalances, so tendencies towards export-led mercantilism, for instance. The analysis of the financial balances revealed some problems related to debt or debt dynamics and over-indebtedness. Doing so on a multi-country or with a multi-country data set allows to analyze the complementarities of these regimes and to discover these regional and global current account imbalances. And finally, we have linked this approach, or can link this approach, towards the stagnation debate, which has come up some 10 years ago. So we have the regime approach linked with stagnation approach, in particular, since we know that these regimes usually are profits without investment regimes. And this means that they are associated with low investment in capital stock, low productivity growth, etc. What is important is that this approach is compatible with very different approaches towards growth drivers. And in our original works, we have always linked that with some rudimentary discussion of potential growth drivers, so distribution, private household sector indebtedness, share and house prices, and also indicators of international competitiveness. The Sraffian supermultiplier growth decomposition approach takes this one little step further by means of distinguishing between autonomous and induced components of demand. Again, I don't go into the technicalities, and we have seen several or some studies on individual countries, and increasingly now also some multi-country studies. What I find interesting in these multi-country studies is that they usually show that the super multiplier is not constant if we do this medium to long run empirical work, and shows some trend, which means that behavioral coefficients and distribution change over time, and which means that we're not in this long run equilibrium in which only autonomous demand dynamics affect growth, but also those induced components have an impact through a change in propensities to consume, to invest, on which distribution may have an impact. So in other words, I don't see such a big difference between this approach and the other approach. Of course, it can give interesting insights into growth drivers, because it provides us with a systematic lens of looking at growth drivers, looking at autonomous parts and looking at induced parts. What is missing here are large-scale multi-country analysis for discovering growth patterns. And then we have a third level of analysis in which authors are looking at growth drivers. And I see this complementary to the first two levels. There is the research strand by Jan Behringer and Til van Treek, who are focusing very much on the existence or non-existence of relative income effects in the countries, and argue that through this lens we can explain, on the one hand, the debt-led approaches, on the other hand, the export-led approaches. The problem here is that they are not so much looking at change over time, not looking at breakpoints, which is the focus in much of the other work. Also, there is a bit of debate in post-Keynesian economics whether these relative income hypotheses can really be found empirically using different methods. Another lens of looking at growth drivers is the work by Ryan Woodgate, focusing only on small open economies, and he will present that in the next session, so I will not look more on that. Deriving FDI-led and tax competition-led demand and growth regimes for small open economies exposed to multinationals, FDI, and also tax shifting or tax competition. And then we have the work looking at trying to look at changes in growth drivers over time. As I said, we've tried to do that in a rudimentary way already in the growth decomposition approaches. We have argued that this tendency towards export-led mercantilism on the one hand and domestic demand-led on the other hand after the crisis can be explained by the requirement of deleveraging and the possibility of using government deficit spending. Carsten Kohler and Engelbert Stockhammer have provided a very interesting systematic analysis of that for 30 OECD countries, and they show that for these developed capitalist economies, the need for deleveraging in the context of a boom-bust cycle is an important explanation for growth differences after the crisis, as is the lack of or the use of expansionary deficit finance fiscal policy. Benjamin Jungmann has extended this to emerging economies and don't find a pattern for these countries, which is not so surprising because we also find different results using the decomposition approach. What is missing here, I think this is interesting work, but I would like to see a more theory-guided, complete examination of potential growth drivers, either based on the Galetsky-Steindl approach or on the Sraffian supermultiplier approach. With Judith Marcin, we have taken another or a complementary lens, I would say, looking at macroeconomic policy regimes, an idea which had been around already for a long time, assuming that that the macroeconomic policy regime, so the set of monetary, fiscal, and wage and income policies, the interaction, and the institutional background, has a role to play when it comes to growth performance of different countries. And we have applied that for 4 European countries. I don't have time to go through the indicators, and we've shown how the macro policy regime has an impact on the demand and growth regime. We will see some of further work on that in this workshop by Yuanyani, Ted Klaasen, and also by Julia Künast on the countries which you see here. Also in this area, I wished we had more, or we should have more large-scale country analysis to discover patterns on the regional or on a global scale. So as I said, and I can be quick here, I see these 3 levels of analysis as complementary and not as mutually exclusive. Just to conclude, taking this, I think post-Keynesian macroeconomics, based on this, post-Keynesian macroeconomics, I think, can provide a sound macro foundation for this demand and growth regime or growth model analysis. What is underdeveloped in post-Keynesian economics is, of course, the political economy dimension. I showed some examples in which it is included in this descriptive historical analysis, but of course we should reap the benefits of specialization, and I think this is where post-Keynesian approaches can link up with comparative political economy and IPE, and I've shown where the links can be set, or where the links can be. It is about the question of growth drivers. So what are the policy constellations, the social blocks, the institutional environment, also shaped by power relationships, which support or do not support certain growth drivers, and thereby generate a certain demand and growth regime. Thank you very much.
Thank you, Eckhard, for this very broad and interesting presentation.